Is passive investing costing you more than you think? Active ETFs aim to beat the benchmark, while passive ETFs just settle for them. Embrace an active strategy that helps you build stronger portfolios. Invest with a global leader in active fixed income ETFs with JP Morgan Asset Management. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat. The Chase Ink Business Premier Card is a pay-in-full card with flexibility made for business owners who make things happen. Earn a total of 2.5% cash back on every purchase of $5,000 or more. Plus, earn unlimited 2% cash back on every other purchase, giving you unlimited earn potential to invest cash back into your business. Ink Business Premier is part of a suite of credit cards from Chase for Business, designed to meet your needs every step along the way. Learn more at chase.com/business card. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by JP Morgan Chase Bank, N.A., member FDIC.
Did my card go through?
Oh no.
Your small business depends on its internet. So switch to Verizon Business. And you could get LTE business internet starting at $39 a month when paired with select business mobile plans. That's unlimited data for unlimited business.
There we go.
Get the internet you need at the price you want. Verizon Business. Starting price for LTE business internet, 25 megabits per second, unlimited data plan with select Verizon Business smartphone plan savings. Terms apply.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, we'll look to U.S. non-farm payrolls for November and earnings from sneaker giant Nike. I'm Nathan Hager in Washington.
I'm Caroline Hepker here in London, where we discuss Europe's business and political challenges in the face of U.S. criticism.
I'm Doug Krisner, looking at the likelihood of a rate increase from the Bank of Japan.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with U.S. jobs numbers. Non-farm payrolls for the month of November are due out Tuesday at 8:30 a.m. Wall Street time. For more on what to expect, we're joined by Michael McKee, international economics and policy correspondent for Bloomberg Radio and Television. First off, Mike, I don't really remember having a Jobs Tuesday before. The government shutdown's really changed things, hasn't it?
It really has. Somebody said the other day, given the schedule for the releasing all the data that we didn't get before, that it's soon going to be 2026, except at the Bureau of Labor Statistics, where it'll still be 2025 for quite some time.
So what are we expecting with the numbers due out this coming Tuesday on a delayed schedule then?
Well, to be totally honest, we're expecting a lot of confusion because what they're doing is trying to put out as much of the October report in terms of the establishment survey, where they count how many jobs, as they can, but they don't have complete data. And then they're going to put out the November payrolls report with most of the data that they need, but we're going to have to parse 2 months there together. And some of it the data won't even be there. So we're going to have to take it with a bit of a grain of salt but it will give us a better view of sort of where we are right now. The biggest issue is going to come on the other side, the household survey, which gives us the unemployment rate because there's no data for October. Wow. So they got to jump right into November, and they didn't get started questioning people until the end of November, which creates some statistical anomalies that are probably too nerdy to talk about, but it's going to be a rough report to make a lot out of.
Okay, so since we have those holes in the household survey, even with the November numbers coming out, does that raise some questions in the market about what the reliability even of the November data?
It should. And Jay Powell, in his news conference this past week, said the very same thing, that the Fed is going to have to really analyze this and not take it at face value because they understand the statistical issues that are involved. Now, the good thing is for the Fed, they don't meet again until January 28th. And so therefore, they will have the December numbers, which will be a complete report, at least, to go on before they have to make another decision. But we will get more information than we have had. And in certain categories of jobs, we'll get good information because a lot of that stuff comes in electronically, wasn't affected by the government shutdown. But there will be gaps in the numbers for October, November.
So in terms of the gaps that are meant to be filled here, what particularly are you looking for that is going to be filled in, and what's your expectation there?
Big companies, manufacturing companies, people like that, are and large retailers, they have computerized records that they send in to the Bureau of Labor Statistics. So those kinds of numbers will show up. It's going to be harder for them to count things that are at small businesses, which are surveyed but don't necessarily send in their stuff electronically, or construction workers because they're sort of itinerant and can be from job to job, and home healthcare workers. Now, that's going to be interesting because home healthcare has been the biggest job creator in the last few years, and so we might get a distorted number there that would kind of throw off the total.
In terms of the data that we've gotten from the private sector so far, we've seen all sorts of ADP figures, the Challenger Grain Christmas layoff notices as well. What does that tell us about what we could see from the rest of the data that's coming from the BLS?
I think all it will tell you is that they sort of confirm the idea that the hiring environment has slowed a lot. Neither one of them is a particularly good predictor of what the overall BLS numbers will be. It's just kind of gives you some data that give you a direction, but not necessarily a magnitude. So I don't think we go into it with a completely clear expectation for what the numbers are going to be. The consensus forecast at Bloomberg has asked the economists is for 40,000 jobs. But again, that's combining 2 months, so there might be job losses in 1 month and job gains in another month. And it's really hard to know where we end up. You kind of just have to take it as it comes.
And you mentioned that there's going to be kind of a hole in the unemployment rate with the household survey on hold due to the shutdown. But what's the trend when it comes to the unemployment rate? Are we seeing more people getting into the job market?
Well, we're seeing the last data we have is from September, and more people did go into the labor market, and that's one reason that the unemployment rate went up a bit in September. We don't know what has happened since, and one of the issues is, of course, that the administration is deporting as many people as they can deport as fast as they can, and that's cutting down on the size of the labor force. But we don't have exact figures. So that will also be an interesting aspect of these reports to see whether or not we're losing workers or losing potential workers because they have been kicked out of the country. That would probably raise the unemployment rate. So there are some other concerns. And one thing I didn't mention is that a lot of the people who were fired by DOJ or took early retirement because they thought they were going to get fired, they were on the payrolls till the end of the fiscal year, which was September 30th. So we could see a big drop in government payrolls in the month of October, and that would have the effect of depressing the whole thing, and it might increase unemployment numbers some, but it looks like at this point not a whole lot. But it does complicate even more the whole task of sorting all this out.
Yeah, lots to sort out ahead of Jobs Tuesday. Thanks, Mike. Appreciate this. That's Michael McKee, Bloomberg International Economics and Policy Correspondent. We move next to corporate earnings from Nike. The sneaker giant reports second quarter results on Thursday. For more on what to expect, it's got to be Poonam Goyal, senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Poonam, thanks for being here. I mean, the swoosh has kind of been crushed lately by the competition, hasn't it? So what are we expecting this time around from Nike?
Yeah, I think right now we're just holding tight, kind of waiting for the turnaround to take shape. We think Nike is making all the right moves to get itself back on track. That said, earnings will be a little light, and that's as expected. We do expect sales to fall, turn negative again in fiscal 2Q, slipping by low single digits, and that's after it posted a slight gain in the last quarter. I'm not so worried about that. My main concern is Nike moving forward on clearing inventories? Is Nike innovating to draw full price sales of the new stuff that it's introducing? And it is.
So you say that Nike is doing the right things to do that turnaround. Talk a little bit more about what you're seeing, why you think Nike might be getting back on the front foot, to keep using puns.
Yeah, I guess, the biggest move for me that they are making to right size the brand is right sizing inventories. Inventories have been very elevated for Nike for a few years now, and just bringing them down and really getting them to realign with sales is the number one factor that I'm looking for, to have them kind of take out everything that's old, that they made too much of and that wasn't working, to really bring in the new stuff more mainstream. The other thing is innovation. So when you think about what Nike was doing just, 3 to 5 years ago, it was just introducing the same thing with a different color wave. That simply. I mean, they were doing a lot of other things, but there just wasn't as much innovation as the customer demanded. I think that's changing. I think they are adding more performance, more innovation to their product lineup. I also think that they're going back on the playing field. So, one question that I get asked often is, how did Nike let Hoka and the Ons take share from it? And the best answer I could give is, it's because they weren't on the field. They weren't where the runners were. They kind of took a back seat in the sport, and they focused on digital too aggressively. That's all changed. They're back on the field. They're at the runs. They have shoes that the runners are wearing. They're showing off. And quite honestly, they are competitive, and they are just as good, if not better, than some of what's out there in the competition.
Well, that's been the thing, right? Because there has been so much attention on these upstart sneaker makers. You mentioned Hoka and On coming out with these more, innovative products compared to what Nike's product line has been over the last few years. What is it that Nike's doing? What kind of changes is it making to sort of meet up with that competition?
It's being where the runners are. It's very simple. It's back to 101. We need to be on the running grounds. We need to be at the races. We need to have the runners wear our shoes and believe that they are the best shoe for that sport. They're doing all of that now. It's just a matter of time. I think we'll start to see it in the results. The other thing I would say is, we talk about these emerging brands, or I guess these newer brands taking share. But when you think of the market share that Nike holds, given its size, it's still the number one footwear brand in the world. And we ran a survey at BI just last month asking consumers, when you shop for sneakers, especially athletic sneakers, who do you wear? Nike was still number one. And yes, Hoka and On are definitely gaining traction, but Nike leads still by a wide margin.
Is Nike putting out the kind of product that sneakerheads are still willing to pay top dollar for? I know some of these models can really drive into pretty high price points. Is that something that Nike is able to meet?
Yeah, I think so. And if you think about the price points that Nike is launching these new products at, they're pretty competitive with what's out there in the competition. So the nice thing about Nike is that they have a range of price points, right? So if you want to buy sneakers starting at $70, $80, you can at that $100 price point, but you can go as high as up to $240, $250 too for like the most premium sneaker that they offer. And when you think about the competition, I think they do too offer sneakers, in the $140, $160, and north of $200 range, and depending on the style that you're looking at.
Really appreciate this, Poonam. Thanks again for being with us. That's Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. And coming up on Bloomberg Daybreak Weekend, we'll look at Europe's business and political challenges in the face of U.S. criticism. I'm Nathan Hager, and this is Bloomberg.
Is passive investing costing you more than you think? Active ETFs aim to beat the benchmark, while passive ETFs just settle for them. Embrace an active strategy that helps you build stronger portfolios. Invest with a global leader in active fixed income ETFs with JP Morgan Asset Management. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
Support for the show comes from Public. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt. From renewable energy companies with high free cash flow to semiconductor suppliers growing revenue over 20% year over year, you can literally type any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and lets you backtest it against the S&P 500. Then you can invest in a few clicks. Generated assets are completely customizable and based on your thesis, not someone else's. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Paid for by Public Investing. Brokerage services by Open to the Public Investing, Inc., member FINRA and SIPC. Advisory services by Public Advisors, LLC, SEC registered advisor. Generated Assets is an interactive analysis tool. Output is for informational purposes only and is not an investment recommendation or advice. Complete disclosures available at public.com/disclosures.
When you own your own business, you own every decision. Now own the card that rewards you for it. The Chase Sapphire Reserve for Business card brings the best Sapphire Reserve benefits to business owners who expect hardworking rewards. Designed to meet the needs of business owners at scale, this pay-in-full card elevates your travel experience and offers premium benefits and value toward business services that can take your business to the next level. Sapphire Reserve for Business provides over $2,500 in annual value. Fuel your business and maximize rewards with 8x points on all purchases through Chase Travel, 3x points on social media and search engine advertising, annual partnership credits, and more. Make every journey more rewarding with a $300 annual travel credit and access to a network of airport lounges, whether you're looking for pre-flight productivity or time to rest and recharge. Chase Sapphire Reserve for Business. With over $2,500 in annual value, it's the card that gives back all you put in. Learn more at chase.com/reserve business. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by JP Morgan Chase Bank, N.A., member FDIC.
Did my card go through?
Oh no.
Your small business depends on its internet. So switch to Verizon Business. And you could get LTE business internet starting at $39 a month when paired with select business mobile plans. That's unlimited data for unlimited business.
There we go.
Get the internet you need at the price you want. Verizon Business. Starting price for LTE business internet, 25 megabits per second, unlimited data plan with select Verizon Business smartphone plan savings. Terms apply.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in the program, we'll look at whether the Bank of Japan will raise interest rates. But first, in the coming days, global leaders convene in France at the Conference of Paris. It is an annual gathering in the City of Light, which encourages knowledge sharing on economic, social, and environmental issues in the hope of collaboration to overcome the world's challenges. Meanwhile, political leaders are gearing up for the European Council meetings where priorities will be on Ukraine and its security. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Nathan, Europe is facing complicated times. A weak economy, the war in Ukraine, and a strained relationship with the Trump White House. 3 persistent and intertwined challenges the continent has grappled with throughout 2025. The region's leaders are deeply concerned by US efforts to end the nearly 4 years-long conflict in Ukraine by cutting a deal with the aggressor, Russia. But what action can European leaders take? From J.D. Vance's speech at the Munich Security Conference in February through to the 33-page national security strategy signed by President Trump that claims Europe risks civilizational erasure. The issue for Europe, according to JP Morgan CEO Jamie Dimon, is anti-business bureaucracy, internal fragmentation, and a lack of innovation. He told Bloomberg's Caroline Hyde that Europe needs to make serious changes to survive.
I think Europe has a real problem. It's very hard to look at the world and we have moving tectonic plates. You've heard it spoken about. It's AI. The enemy's in the satellite up above and in your computer systems right now. And the world changed. The other tectonic plates, the rise of China, huge global deficits, social network programs that probably can't be maintained over a long period of time. So Europe has a problem. I think they accomplished an unbelievable thing when the Euro got together, the EC, and they said, let's live in peace and not war. They had World War I and World War II, but they had the Franco-Prussian Wars, the Napoleonic Wars, the 100 Years' War, the War of the Roses. And so living in peace is a good thing, but it got bogged down. They never finished the common market. It takes 27 nations, to make a decision. They let their military drop dramatically. It's very bureaucratic, which is why part of the reason that, they lost Britain to the EU, which I think makes it bad for both of them, by the way. And so you got to be honest about this. So, and those tectonic plates may move over 20 years. But if we ever write a book about how the West was lost, it will be because of the following. It will be because of we didn't get our act together here, and we go through all the policies here, that we didn't have the strongest military in the world, and that we allowed Europe to fall apart.
That was JP Morgan CEO Jamie Dimon speaking there to Bloomberg's Caroline Hyde at the Reagan National Defence Forum. Questions of European security and collaboration with the US will be major points of discussion at the Conference of Paris in the next few days. Speakers include Bruno Le Maire, the former French economy and finance minister, and Ken Griffin, CEO and founder of Citadel. It's also an issue that will be on the minds of leaders at the upcoming EU Leaders Summit in Brussels. Well, joining me now for more is Ben Sills, Bloomberg's managing editor for European government and economy. Ben, good to speak to you. Firstly, I'd just like your reaction to what Jamie Dimon had to say. Really, his comments have dominated news in Europe over the past few days, saying that Europe has a big problem. What do you think the response and the thinking is in Brussels and across Europe?
Well, I think he's right, for starters. I think most people, most European officials will recognise that he's right. He's not the first person to say this, but when somebody as influential as Jamie Dimon makes that sort of comment so publicly, it has to sting. I think that will it lead to a bit more soul searching? I'm not really sure, to be honest. I think like the Draghi report last year was arguably a more substantial and more kind of conspicuous call to arms for European officials, and the progress on the back of that has been limited, and the progress on so many of the critical files for the European Union has continued to be kind of plagued by the same old problems of the need for consensus, the divisions over the sort of kind of vision of the sort of European economy that people want to build, and that just kind of constantly holds the European Union back.
Do you think that it is something that European leaders are going to think about at this EU Council meeting or at the Conference of Paris, where we're going to see, again, a number of leading US CEOs speaking to Bloomberg, speaking to the investor community? And we know that the Draghi report has has not perhaps had the galvanizing impact that maybe, the former ECB president might have wanted to see?
I would imagine it's likely to be a topic for discussion on the sidelines. I would imagine that Emmanuel Macron, who is always one for articulating his grand vision, might be talking about those sorts of issues. But what we've seen summit after summit is that Macron's rhetoric is not successful in persuading the rest of the European leadership to kind of come along and to take decisions. And we've got the very kind of concrete, tangible decision on the table of what they're going to do about Ukraine, what are they going to do about the frozen Russian assets. And that's the real test. If the Europeans want to prove at this moment, when the White House is really stepping up its push for a settlement of the war in Ukraine, the single most important thing the Europeans can do is find a way to supply substantial amounts of additional financing to Kyiv with this mechanism based on the frozen Russian assets. And they've been going round and round in circles on that for months. So now it's really time for them to deliver on that one.
And that, again, is the issue that President Trump raised also just in the past few days, criticising the talk, the lack of action as he sees it. Also, again, using this very strong, very critical language about Europe. It really does seem that the Trump White House has the EU in its sights. And he's talking about European nations decaying. This also must have an impact on leaders in Europe too. I mean, I just note that the former EU diplomat Josep Borrell saying European leaders must stop pretending that Trump is not our adversary. Are we at that point yet?
The Trump administration, I mean, their rhetoric flips back and forth a little bit, but we heard I was at the Munich Security Conference in February where JD Vance delivered that really shocking speech attacking the European Union, attacking the kind of the democratic norms on which European societies are based. And it was pretty clear then that any support, any kind of legacy support that the Europeans were going to be getting from the US was going to be kind of limited, qualified, and certainly not something that you could count on. And we've seen that come back with a vengeance with the US national security strategy, which came out last week with that really quite shocking language about civilizational erasure, and following up with those with Trump's comments in his interview this week about the weakness of European leaders. I have to say, I've lived in Europe for more than 20 years, and I don't see much sign of civilizational erasure. But I do think he's right when he says that the European leaders are weak, and I think that they've been demonstrating that with their failure to muster proper support for Ukraine, despite all of their talk.
Yes, I suppose. To that raises issues around migration, anti-immigration within Europe, but also, as you say, the litmus test is Ukraine. In the next few days, what do you think is going to change? Who is maybe best to engage with President Trump on the European side? The Europeans have been trying to get into that negotiation, that process of the US wanting to get to a deal with Moscow. But it's about speed and who engages.
Yeah, I think that it's pretty clear by this stage in the process that if the Europeans want to have a seat at the table, they need to earn that by putting down some serious support, whether that's money, whether that's weapons, whether that's political commitment, whether that's boots on the ground in Ukraine. They need to be making a real kind of concrete commitment to Ukraine, which will demonstrate to the US, to Russia, to the Ukrainians that the Europeans are serious about taking unilateral measures outside of the kind of US umbrella to defend and promote their own interests And so far, we haven't seen that.
I think, I don't know for sure, but I think it would have flown a little more under the radar again in recent days. The address that the Chancellor of Germany, Friedrich Merz, made on TV to German voters in the last few days, where actually he was, kind of countering what was happening in the US and was a little bit critical, I'd say even fairly critical of the United States. And I think, again, there are moves in Europe to spend a lot more on defence. And just in the last few days, that has been, commitment by Germany to build out its conventional armed forces. So there is a response that is happening, isn't there, in Europe?
Yeah, that's right, actually. And I think German defence spending, if you're looking for arguments to support the idea that the Europeans are getting serious, then German defence spending should be top of the list. The increase in German defence spending is significant. It's real. It's happening. And it's going to have a meaningful impact on European security in the next decade. And that's, without doubt, Merz's biggest achievement, I would say, in a difficult first year in office.
Ben, thank you so much for being with us. There'll be plenty then for both Europe's political and business and finance leaders to think about in the next few days with a couple of big events in Europe. Ben Sills is Bloomberg's managing editor for European politics and economy. Thank you. We will have full coverage in the next few days of the Conference of Paris with our own Francine Lacroix and Danny Berger and the EU Leaders Summit right here on Bloomberg Radio. I'm Caroline Hepke in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, we look ahead to a monetary policy decision from the Bank of Japan. I'm Nathan Hager, and this is Bloomberg.
Support for the show comes from Public. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt. From renewable energy companies with high free cash flow to semiconductor suppliers growing revenue over 20% year over year, you can literally type any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and lets you backtest it against the S&P 500. Then you can invest in a few clicks. Generated assets are completely customizable and based on your thesis, not someone else's. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Paid for by Public Investing. Brokerage services by Open to the Public Investing, Inc., member FINRA and SIPC. Advisory services by Public Advisors, LLC, SEC registered advisor. Generated Assets is an interactive analysis tool. Output is for informational purposes only and is not an investment recommendation or advice. Complete disclosures available at public.com/disclosures.
When you own your own business, you own every decision. Now own the card that rewards you for it. The Chase Sapphire Reserve for Business card brings the best Sapphire Reserve benefits to business owners who expect hardworking rewards. Designed to meet the needs of business owners at scale, this pay in full card elevates your travel experience and offers premium benefits and value toward business services that can take your business to the next level. Sapphire Reserve for Business provides over $2,500 in annual value. Fuel your business and maximize rewards with 8x points on all purchases through Chase Travel, 3x points on social media and search engine advertising, annual partnership credits, and more. Make every journey more rewarding with a $300 annual travel credit and access to a network of airport lounges, whether you're looking for pre-flight productivity or time to rest and recharge. Chase Sapphire Reserve for Business. With over $2,500 in annual value, it's the card that gives back all you put in. Learn more at chase.com/reserve business. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by JPMorgan Chase Bank, N.A., member FDIC.
Did my card go through?
Oh no.
Your small business depends on its internet, so switch to Verizon Business. And you could get LTE business internet starting at $39 a month when paired with select business mobile plans. That's unlimited data for unlimited business.
There we go.
Get the internet you need at the price you want. Verizon Business. Starting price for LTE business internet, 25 megabits per second, unlimited data plan with select Verizon Business smartphone plan savings. Terms apply.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. In the coming days, the Bank of Japan is expected to raise its policy interest rate. For a closer look, let's bring in the host of the Daybreak Asia podcast, Doug Krisner.
Nathan, over the last month, we have seen more bets placed on a BOJ rate hike in the coming week. Right now, the swaps market has assigned a 91% probability of a 25 basis point increase. Now, if that comes to pass, it would take the BOJ's policy rate to 75 basis points, and that would be a 30-year high. Just a month ago, the probability of a rate hike was less than 50%. Let's take a closer look now at the dynamics surrounding the BOJ's decision with Bloomberg's Paul Jackson. Paul covers the economies of Japan and South Korea, and he joins us from our studios in Tokyo. Thank you for making time. Can you help me understand how we got to a 91% probability when a short while ago the probability was less than 50%?
Well, it all relates really to a speech at the beginning of December by Bank of Japan Governor Kazuo Ueda, in which he said the central bank would consider the pros and cons of raising interest rates at its next meeting. Now, that is seen as key language hinting at a rate hike. Subsequently, Bloomberg reported that key government officials would not try to block a rate hike. And also, separately, we reported that officials at the bank were ready to raise the rate. And so that has had a dramatic effect on expectations for a rate hike at the upcoming meeting.
Is there any conversation around the possibility that the BOJ may have fallen a bit behind the curve?
Absolutely. Obviously, we've seen comments from American officials, including Scott Bessent, about the risk of falling behind and whether the BOJ is acting fast enough. We have inflation at 3%. I don't know about you, Doug, but to me that seems to be higher than the Bank of Japan's 2% target. And you know what? It's been there for more than 3.5 years. So in terms of conventional policy making, you would want to raise rates to cool inflation. And, just another perspective on this is that with inflation at 3%, if your central bank rate, even if you raise it to 0.75%, you're still way below the inflation rate. That means real interest rates are deeply zero. And to extend that model a bit further, if you think in terms of where inflation was in April 2021, it was actually falling. Prices were falling by 0.9%. So at that time, a negative interest rate at the Bank of Japan of minus 0.1 was actually positive. 0.8% positive at that time, whereas now we're deeply, deeply negative. So, I mean, to all intents and purposes, it seems crazy that we're still so low.
So, Paul, when we consider the rates environment in Japan and we look at the Japanese bond market, what becomes apparent?
Well, I think in the bond market, among investors, there are concerns on the one hand about how much spending Sanae Takaichi's government is going to conduct. We've seen this hefty economic package unveiled last month, and there could be more spending down the line. So that raises some concerns about what's going to happen with bond issuance and so on. Also, I mean, if interest rates at the shorter end are going to be going up, then that's that's going to affect things across the curve. When you think about it, I mean, just getting back to the earlier point, if inflation is at a much higher level, then interest rates also naturally would be expected to go up.
What do we know about the path of rate increases in the new year? Might we see any? I'm wondering if Governor Ueda has dropped any hints. What do we know?
Well, I think this is going to be the key point of interest at this meeting, given that the rate increase is largely expected by everyone. So what is Mr. Ueda going to say about the future course? I mean, I think he's going to stick to some formulaic language on if our outlook is realized, we will continue to raise interest rates. But the key point is how fast are they going to do that and how far will they go? And I think before we had Donald Trump's tariffs, before Takaichi took over as prime minister, the understanding was that the Bank of Japan wanted to raise interest rates at a pace of about every 6 months, once every 6 months. And then with those tariffs and the arrival of Takaichi as prime minister, that understanding kind of changed to, well, maybe it's more like once every year, once a year. Now, I think that's what investors are going to be looking at this meeting. Which one is it? Is it once every 6 months or once every year?
We know the Japanese economy has struggled a bit in the face of those U.S. tariffs. Is there the sense now that Japan, by and large, has been able to absorb the initial shock without too much difficulty?
Well, the latest GDP figures showed a contraction of 2.3% in the third quarter, so that's not a great number. Part of that was a tariff effect, but that was kind of reflected a pulling back of exports over the summer after some front-loading ahead of what people were fearing would come from the tariff barrage from Donald Trump. So I think the takeaway is, okay, bad GDP figures for the summer, but we're probably going to return to growth now. And the hit from the tariffs is, surprisingly mild compared from what expectations were in the darkest moments earlier this year.
So when you say growth, is that based on the notion that Prime Minister Takaichi is going to deliver the sort of stimulus to reinvigorate the economy in a meaningful way?
Yeah, I think we're going to have a rebound from the summer. There were some technical factors in the housing market that also contributed to the contraction. So I think we're going to return to growth. Now, we're not talking gangbuster growth here. We're talking moderate growth. But in the environment of tariffs, if that can take place, that is a positive. And in terms of whether the Japanese consumer is adjusting to the reality, the new reality for many Japanese of inflation, of prices going up, we are seeing consumption very, very slowly on an upward path. It's not hugely strong, but it is pointing in the right direction.
I'd like to get your sense of this skirmish, if I can use that term, between Tokyo and Beijing. Maybe it's a little more than that after Prime Minister Takaichi's comments on Taiwan. I'm trying to get a sense of the risk of stress in the trade relationship between China and Japan, and if China were to create some difficulty here, how that might impact the overall Japanese economy.
I think the spat between China and Japan can have an observable effect on Japan's economy. Coming up this week, we will be seeing the latest tourist information data, and we expect to see a drop in the number of Chinese tourists to Japan in the month of November. Now, the Chinese tourists are the biggest spenders among foreign visitors to Japan, so that will have an effect. But this kind of impact on GDP, is that enough to move the needle and change the Japanese government's thoughts on how it should respond to China? I don't think so. I think it's going to be an observable impact, but not big enough to really move the needle. However, China does have some other possibilities, and of those, the scariest probably would be cutting off rare earth supplies. Now, that might give policymakers in Tokyo food for thought.
So, Paul, we know in the last week, the Fed cut its policy rate by 25 basis points. Now, that move was widely expected, and at the same time, officials maintained the outlook for just one rate cut in the new year. And if you look at the Fed's statement, it was reworded in a very subtle way to suggest greater uncertainty now about when the Fed might cut again. Nonetheless, we did see some dollar weakness, and of course the flip side of that was a stronger Japanese currency. When you look at what's happening with the Fed vis-a-vis the Bank of Japan, does Fed policy right now take much pressure off the Bank of Japan, particularly going back to this notion of a stronger currency, what it would do in fighting inflationary pressure?
Well, the currency dynamics are very interesting. I mean, a large factor in yen weakness is the difference in real interest rates between Japan and the US. Now, I think what we've seen since the whole tariff war started was that differential element, that aspect, has had less of the correlation between the difference in interest rates and where the Japanese yen is against the dollar is kind of out of sync quite a bit from where you'd expect it to be. In other words, what I'm saying is the yen would actually be quite a bit stronger than where it is at the moment. So that kind of speaks to the uncertainty factor out there.
We know inflation in Japan has been persistently above the BOJ's 2% target for quite a number of months now. I think that may be an understatement. I'm curious about the inputs that have been the primary drivers.
Well, I think in terms of the inflation at the moment, the main culprit is food inflation. And I think it's the movements there that will be one of the key drivers to the inflation trend over the coming months. Another factor that we need to be cognizant of is that in Prime Minister Takaichi's package for the economy, there are some more subsidy measures for households to deal with electricity bills and gas bills. And some of these measures are already forecast by the government to shave off about 0.7 percentage point off inflation. So I think we are going to see much lower figures coming in over the coming months. And, you could argue that that's why the BOJ also wants to get a rate hike out of the way, because you want to go while the figure's still looking hot.
What about the story on wages? That was such a focal point for such a long time, waiting for wages to have a meaningful uptick. Has wage inflation improved?
We're seeing a pretty solid trend. If you look at the figure for wages for full-time employees in regular jobs, it's around the 2.2% mark for a stable sample. There's lots of numbers out there, but I think that's one of the ones to really focus on. It gives a much more stable view of the trend. Now, compared with previous years, that's a very, very solid figure. But compared with 3% inflation, that is not a great number, because that means your purchasing power is getting weaker in real terms all the time. And I think that's the big thing that needs to change, is we need to get the wage increases ahead of where the inflation rate is to really turn around the consumption figures in the economy and drive growth.
Paul, it's always a pleasure. Thank you so much for helping us preview this week's BOJ decision. Paul Jackson there from Bloomberg News. He covers the economies of Japan and South Korea. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
With the B2B card payment landscape evolving, large corporations face pressure as buyers increasingly demand to pay invoices by virtual card. For merchant acquiring businesses like yours, this is a high-growth opportunity waiting to be unlocked. With MasterCard's adaptive approach to B2B acceptance, you can enhance your infrastructure for high-value payments and meet your customers' unique needs. MasterCard offers solutions and support for every step of the supplier lifecycle, helping you deepen merchant relationships. Start fast, grow strategically, and scale at your pace. With a modular toolkit you can flexibly deploy. Discover how at mastercard.com/commercial acceptance.
We buy insurance for peace of mind, but every year millions of claims are denied. Not because people did anything wrong, but because their policies quietly excluded what happened. Insurers know every detail. Policyholders rarely do. That's why My Policy Advocate exists. For just 27 cents a day, their platform reads your policies and explains where you are vulnerable. They don't sell insurance, they deliver transparency. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Go to mypolicyadvocate.com.
As a contractor, I don't pay for materials I don't use. So why would I pay for stuff I don't need in my mobile plan? That's why my Biz plan from Verizon Business is so perfect. Now I can choose exactly what I want, and I only pay for what I need.
Right now, with my Biz plan, get our best price, as low as $25 a line. Visit Verizon.com/business to get started today. New lines only. Price per month with 5+ lines. Includes auto pay and paper-free billing and promotional discount. Taxes, fees, economic adjustment charge. Applicable add-ons, prices, and terms apply. Guarantee applies to base monthly rate and stated discounts only. Add-on prices additional. Offers in January 5th, 2026.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/stories.